Before the systems we know today, banks, markets, central banks, stock exchanges, there was something more primitive, yet more honest. People traded real things: grain, metals, livestock, land. You could physically see what you owned. But the moment money stopped being physical, the game changed. Enter the financial illusion grid, a layered network of institutions, agreements, policies, and manufactured signals that look like economic order, but function like a control mechanism. To understand it, we need to peel back the layers, slowly, because the twist is this: the people operating the system aren't the ones who appear to be in charge. The first protogrid emerged in the late Middle Ages, when European monarchies were running out of gold to fund their wars. They needed a workaround. Then came a radical idea. If we can't find more gold, we'll invent more claims to it. This idea birthed the earliest debt markets. Merchants exchanged paper promises backed by the king's word, not actual gold. At first, these were temporary IOUs. But monarchs quickly realized something. If a piece of paper could command resources just as effectively as gold, why bother waiting for gold at all? This was the first quiet pivot. Wealth shifting from physical stores to symbolic claims. A single piece of parchment could direct armies, reroute trade, or reshape entire economies. The illusion grid had its foundation. Fast forward to the 17th and 18th centuries, nations discovered that whoever controlled the flow of credit controlled the world. Central banks emerged not as neutral guardians, but as institutional signal towers, broadcasting the value of money, controlling interest rates, and deciding who received credit and who didn't. Most people picture governments controlling central banks, but historically, many early central banks were private cartels with public partnerships. They didn't farm land, they didn't build ships, they didn't mine silver. They issued credit, and nations became their clients. As economies industrialized, the grid expanded again. Banks, clearinghouses, insurance networks, stock markets, bond markets, currency exchanges, each became a node in the growing financial lattice. But here's the real twist. While the public believed money reflected national wealth, the grid allowed money to shape national policy instead. The illusion was now complete. There was a moment, a specific moment, when the entire system crossed a line. The end of the Bretton Woods system. The US dollar officially detached from gold. From that day forward, money wasn't tied to any physical resource. It became a pure signal, a digital language. It's controlled by a select group of institutions. It could be expanded, contracted, or rerouted with policy tools. Interest rate cuts, quantitative easing, repo operations, swap lines, reserve requirement changes. To the public, these sound like technical adjustments. Inside the grid, they are power levers. This was the shift. Countries no longer competed over resources alone. They competed over the ability to manipulate financial signals, whoever controlled the signaling mechanisms. Central banks, major clearing networks, global payment systems controlled the world economy. The illusion grid worked too well, because once money became unlimited, the incentives warped. Governments borrowed endlessly. Corporations engineered stock prices over products. Banks expanded credit far beyond deposits. Speculators turned markets into casinos. The grid didn't just guide the economy, it became the economy. Then the cracks appeared. 1987-1998-2008-2020-2023 mini-banking crises. Each event revealed the same pattern. The grid collapses. The public suffers. The operators get rescued. The grid grows stronger. The illusion is not in the crashes. The illusion is that they're accidents. They're side effects of a system designed to expand, centralize, and conceal. Every crisis sparked promises of reform. But look closely. Every fix added complexity. New regulations, new agencies, new oversight mechanisms, new emergency powers, new credit tools, new digital protocols. Each solution created new layers, making the system harder to understand, harder to challenge, and easier to control. The real owners remain invisible because complexity is their shield. Opacity is their weapon. Confusion is their greatest asset. The illusion grid thrives when the average person believes money is too confusing to understand and too complicated to question. Today, the grid is more powerful than ever, and it's going digital. Data point examples viewers never hear. Over 90% of global money exists only as digital ledger entries. A handful of institutions clear. The majority of the world's transactions, hedge funds can move more money in a second than some nations produce in a month. Central banks bought trillions of dollars in assets. With money created from nothing since 2008, over 70% of stocks trade between algorithms, not humans. The pattern is unmistakable. Every decade, control consolidates upward. Every crisis accelerates it. Every innovation strengthens it. We aren't watching markets. We're watching signals inside a grid designed to look natural, but built to be controlled. And most people never even notice. To understand how deep this goes, we need to challenge the biggest financial assumption of all. Nations control their economies. It sounds logical. Governments write laws. Central banks set interest rates. Politicians debate budgets. But if you zoom out, the picture changes. It's a small network of international institutions. Often unelected, sometimes private. Always opaque, dictates the rules that nations must follow. Global banking networks, international clearing systems. Ratings agencies, supranational lenders, commodity benchmarking cartels, cross-border payment authorities. These institutions form a financial architecture that looks decentralized, but acts like a single machine, a machine that can reward or punish entire countries. But how did it begin? To trace it back, we must return to the early 1900s. When the global economy was switching from empires to nation-states, countries needed massive capital to industrialize, but they didn't have enough gold, resources, or infrastructure to fund it. Then came the key event, the creation of international bond markets. Suddenly, nations could borrow from foreign investors, powerful families, banks, and private financial houses. At first, this looked like progress. More railways, factories, and trade routes. But the twist came later. Because once a nation becomes dependent on global credit, the lenders set the rules. Interest rates became political weapons. Currency valuations became bargaining chips. And the people holding the bonds, not the governments, held the real power. This was the birth of the silent wealth engine. Over the next century, the engine expanded. Layer 1. Central banks. Central banks adopted the same model. Control currency supply, manage national debt, and regulate credit. In theory, they serve the public. In practice, many operate independently, untouched by elections, immune to political pressure, and deeply tied to global markets. Layer 2. International institutions. After global wars and crises, new power players appeared. The Bank for International Settlements, the IMF, the World Bank, the SWIFT network, international banking syndicates. These institutions didn't just advise nations. They dictated conditions, rules, and eligibility for global participation. Layer 3. Credit rating agencies. Perhaps the least understood power. A single downgrade from a private agency can collapse a nation's currency, raise borrowing costs, trigger mass unemployment, and topple governments. 3 agencies, all private, hold this power. Layer 4. Global investors, hedge funds, sovereign wealth funds, and megabanks now move billions with algorithms. In a single hour, they can reshape an entire country's financial stability. By the 1990s, the engine wasn't just influencing nations, it was controlling them. The breaking point came with a series of shocks: the Latin American debt crisis, the 1997 Asian financial crisis, the 2008 global crash, the Eurozone meltdown, the 2020 pandemic economics, the 2023 liquidity distortions. Each event revealed a consistent truth. Nations don't control their economies. The global financial engine does. Governments begged for bailouts. Currencies collapsed overnight. Whole populations suffered austerity, not because of internal mismanagement, but because the engine tightened or loosened its grip. Citizens blamed politicians, but the real decisions were made somewhere else. Today, economic independence is mostly a myth. Countries can't print money freely. If they print too much, global markets punish them with inflation, capital flight, and currency collapse. Budgets aren't fully sovereign. Bond markets can reward or punish spending choices within hours. Currency values aren't controlled locally. Speculators and international clearing networks. exert more influence on exchange rates than local policies. National debt isn't really national. Most modern debt is held by global investors, not citizens. The illusion is not that nations manage their economies. The illusion is that they're allowed to. Countries have tried everything: capital controls, currency pegs, reserve accumulation, nationalization, de-dollarization attempts, digital currency plans. But every fix created new weaknesses. Peg a currency. Speculators break it. Hoards reserves. Crisis drains them. Nationalize banks. International lenders retaliate. Create digital currency. It becomes easier for global networks to monitor and influence. Every attempt to escape the engine only increases its sophistication, because the system adapts, expands, and hides deeper. We grow up believing money works through simple rules. You earn it. You spend it. You save it. You exchange it. But these rules only apply on the surface. Underneath is a far more complex structure, one built on 3 hidden levers: control the cost of money, control the movement of money, control the creation of money. Whoever controls these levers doesn't need to control governments. They control the incentives governments must follow. This is the beginning of the hidden currency circuit. A loop engineered to funnel value upward while looking like ordinary economics. But where did it begin? The circuit traces back to the early days of modern banking. When merchants made a disturbing discovery, people almost never redeem all their money at the same time. This led to a quiet experiment. What if banks issued more receipts for gold than the gold they actually held? As long as withdrawals were spaced out, the bank profited massively. This was the first hidden circuit. Create more claims than real assets, nations noticed. They adopted the model. By the 1800s, central banks formalized it. Money became a promise, not a resource. Promises could be multiplied. This one shift unlocked an enormous form of silent wealth extraction, interest on money that was never actually there. But the circuit didn't stop there. It expanded. As trade expanded, the circuit went international. Layer 1. Currency pegs and reserves. Countries tied their currencies to stronger currencies. To maintain stability, they needed reserves often borrowed. This created permanent dependence on stronger economies. Layer 2. International lending networks. Institutions began lending to governments. Loans came with conditions: privatization, austerity, tax reforms, deregulation. These weren't suggestions. They were mandates. Layer 3. Global clearing systems. Cross-border money had to pass through networks controlled by a handful of institutions. This allowed a new form of control. If you regulate the flow, you regulate the players. Layer 4. Interest rate synchronization. As global economies connected, interest rates started synchronizing under central bank influence. This meant a single institution's policy could affect billions of people across continents. The hidden circuit was no longer a network. It had become a system capable of shaping entire nations.